5 ways that US dollar could hurt the world economy. The US dollar has been on a major surge against major global currencies in the past year, recently hitting levels not seen in 20 years. It has gained 15% against the British pound, 16% against the euro and 23% against the Japanese yen. The dollar is the world's reserve currency, which means it is used in most international transactions. As a result, changes in its value have implications for the entire global economy. Below are 5 of the main ones. Even more inflation. Petroleum and most commodities such as metals or timber are usually traded in US dollars. So when the dollar gets stronger, these items cost more in local currency. For example, in British pounds, the cost of $100 worth of petrol has risen over the past year from £72 to £84. And since the price per litre of petrol in US dollars has risen steeply as well, it is creating a double whammy. When energy and raw materials cost more, the prices of many products go up for consumers and businesses, causing inflation around the world. The only exception is the US, where a stronger dollar makes it cheaper to import consumer products and therefore could help to tame inflation. Low-income countries under threat. Most developing countries owe their debt in US dollars, so many owe much more now than a year ago. As a result, many will struggle to find an ever-increasing amount of local currency to service their debts. We are already seeing this in Sri Lanka, and other countries may soon follow suit. They will either have to tax their economies more, issue inflationary local money, or simply borrow more. The results could be deep recession, hyperinflation, a sovereign debt crisis, or all three together, depending on the path chosen. Developing countries which fall into sovereign debt crises can take years or even decades to recover, causing severe hardship to their people. A bigger US trade deficit. Other countries will buy fewer US products as a result of the strong dollar. The US trade deficit, which is the difference between the amount of exports and imports, already runs close to a mammoth $1 trillion per year. President Joe Biden and Donald Trump before him vowed to reduce it, particularly against China. Some economists worry that the trade deficit drives up US borrowing and reflects the fact that many manufacturing jobs have moved overseas. Deglobalization to get worse. The most obvious economic policy to prevent a trade deficit from growing is the old game of imposing tariffs, quotas, or other barriers on imports. Other countries tend to retaliate against such protectionism, adding their own taxes and other barriers to US products. In an era when deglobalization has already begun thanks to worsening Western relations with Russia and China, a stronger dollar adds to the political momentum for protectionism and threatens global trade. Eurozone fears. Weaker EU member states such as Portugal, Ireland, Greece and Cyprus have become somewhat less vulnerable to investors driving up their borrowing costs to crisis levels than during the darkest days of the Eurozone crisis. This is because much of their national debt is now in the hands of the European Stability Mechanism, which was set up to help rescue them, as well as friendlier investment banks within the Eurozone. However, the stronger dollar is creating pressure for the European Central Bank to raise its own interest rates to prop up the euro and subdue the cost of imports, including energy. This will put more pressure on Eurozone countries with high levels of debt. Italy, which is the 9th largest economy in the world and has government debts at a whopping 150% of GDP, would be particularly hard to bail out if the situation got out of control. Bringing these 5 points together, the ultra-strong dollar is yet another reason to fear a global recession in the coming period. Higher inflation erodes consumer incomes and reduces consumption. Protectionism can reduce international trade and investment. Sovereign debt crises mean serious trouble for many developing countries and possibly even the Eurozone.